Today, the Reserve Bank of New Zealand inflicts more interest rate pain. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news. Well, yesterday, the Monetary Policy Committee in New Zealand voted to raise the official cash rate, the OCR, from 5.25% to 5.5%. This, of course, is consistent with their view that rates need to go higher because the economy needs to be slowed and because the inflation rate is way too high. And during the press conference today, Adrian Orr outlined the rationale for the increase. And it's worth listening to what he has to say because he's pretty open and transparent about what's going on.
Today, the Monetary Policy Committee voted to raise the official cash rate from 5.25% to 5.50%. The committee agreed that the level of interest rates are constraining spending and inflation pressure, and that the OCR will need to remain at a restrictive level for the foreseeable future to ensure that consumer price inflation comes back into the 1 to 3% target range while supporting maximum sustainable employment. Global economic growth remains weak and inflation pressures globally are easing. This follows a period of significant monetary policy tightening amongst our trading partners. International supply chains have also eased following a period of disruption, and shipping costs have declined. The weaker global growth has also led to lower export prices for New Zealand's goods. In New Zealand, inflation is expected to continue to decline from its peak, and with it also measures of inflation expectations. However, core inflation pressures do remain and will remain until capacity pressures ease further. While employment is above its maximum sustainable level, there are now signs of labour shortages easing and vacancies declining. Consumer spending growth has eased and residential construction has declined, while house prices have returned to more sustainable levels. I do have to say it's very pleasing to be talking you through these statistics after a long battle. More generally, businesses are reporting slower demand for their goods and services and weak investment intentions. Businesses report that a lack of demand rather than labour shortages is now the main constraint on activity. There has been a return of net inward migration since international borders reopened, and the committee expects the pace of that immigration to ease back toward pre-COVID-19 trend levels over coming quarters. While immigration has assisted to ease the labour shortages, its net impact on overall spending in the economy remains uncertain. The recent recovery in tourism spending to around about 3/4 of the level it was at pre-COVID-19 is also supporting demand. And the repair and rebuild facing significant regions of the North Island due to the severe weather events of recent will also support economic activity, particularly in the horizontal construction sector. The timing of this predominantly government investment will be spread over several years. Meanwhile, broader government spending is anticipated to decline in inflation-adjusted terms and also as a proportion to GDP. As a committee, we are confident that with interest rates remaining at restricted levels for some time, consumer price inflation will return to within its target range of 1 to 3% while supporting maximum sustainable employment. Before we open up to questions, I do just want to make a couple of more comments, mostly just around how the committee reached our decision today. And you'll see that today it was the first time that we went to vote to come to a decision. Given that that is novel, I want to just remind people our MPC charter, how we to behave and communicate, and our frameworks all aim to facilitate effective decision making. While we've reached a consensus in previous meetings, a vote can be very effective, and this time it proved to be a very effective way of making a decision. I want to say that we were all in broad agreement with the outlook for monetary policy. We just didn't reach a consensus on the OCR itself, hence the vote. We've published the unattributable vote in our record of meeting, and today and onwards we will always be talking about the committee's decision. We are a committee and we have tools to come to decisions. We stand by this decision as a committee, and I would want to say that it's very pleased to say that everyone has retained full confidence in the process and each other in a very collaborative and constructive style for making today's announcements. With that said, there's a wealth of information. I always love to advertise this incredible document. It's called the Monetary Policy Statement, and it has a wealth of insight and information for all people out there in the economy of Aotearoa, New Zealand.
And during the questions, some interesting topics came up. For example, one journalist asked specifically about the impact of higher rates on households and whether the Reserve Bank had taken that into consideration.
Hey, Jenna Lynch, Newshub Nation. There's always a lot of focus on mortgage holders, but what about everyday working New Zealanders, the 430,000 people that are falling behind on their loans, struggling to pay bills, struggling to put food on the table? What is your message to them?
Our message to them is that inflation is no one's friend. And it is inflation that is causing the most significant economic challenge at present to all New Zealanders, and our job is to return inflation back to its 1 to 3%. What I'd like to say to them is that we're well on the path to achieving that.
But those same people are the ones that would be hurt in a recessionary environment, in a downturn. They don't seem to be a major feature in any of your commentary or analysis. Why is that?
I disagree with your supposition. There is significant, in fact, an entire chapter around the labour market, labour force and maximum sustainable employment.
Those people can't, in your words, cool their jets with their spending. They're borrowing to get the basics. And what they hear from you is that what we're seeing is what we're hoping to observe. Do you feel like you're in touch with the pain that people are feeling right now?
I don't know that comment. So what I'm saying is absolutely we're in touch. Inflation is no one's friend, and we are here to stamp inflation out with monetary policy. I will also point out that unemployment has been at record low levels. Employment and employment engagement in the economy is at OECD record levels, but we need to constrain inflation.
And do you personally take some responsibility for the inflationary environment that we're seeing right now?
I am the Governor of the Reserve Bank. Yes, I do.
And there was another question about the relationship between the wage price spiral and the price hike spiral, in other words, increasing margins. And the Reserve Bank said that both were observable, but no one was leading the way.
And at the last monetary policy statement, I asked about the role of margin expansion in inflation. Since then, the European Central Bank has done some work which seems to suggest some margin expansion, and there have been some other papers. What's the Reserve Bank's view now, a few months on how much of a role margin expansion is playing in the inflation?
I'll say two things and let Paul talk about his challenge on the research there. The first one is the data remains as poor as ever, and the second one, I think it's about all even between labour and profits, wages and profits around the underlying pressure for inflation. Have I stolen everything?
That pretty much covers it. I could probably add a few details. So we have had a good poke at the data, Bernard, just to be sort of up on the risks of a profit sort of price spiral. At the aggregate level, we don't see any evidence of an increase in profits feeding into inflation. So, it's an increase in profits. So it doesn't rule out, the possibility that there are markets in New Zealand that do suffer from a lack of competition and where profits, may be above sort of normal levels. But we haven't seen that increase at the aggregate level. And to the extent that there are markets suffering from a lack of competition, it's the Commerce Commission that are into that sort of space. I kind of, I think of it, it's exactly symmetric. Wage price spiral, profit price spiral. We need to keep an eye on both. And actually across both of those, we're not seeing much evidence of those kind of second round effects at the moment, which is, one of the reasons why we've got a bit of confidence that we're getting on top of inflation and that we'll see significant declines in inflation going forward.
And there was a discussion about home prices, and Adrian Orr admitted that they weren't very good at forecasting asset prices. Well, that's probably true. I think other central bankers should take note of this.
Lucy from Reuters. I'm just wondering, we're starting to see some green shoots in the housing market. How concerned are you guys about the idea that maybe house prices have reached the bottom of where they're going to go? Would you like to see them go further? Are you expecting to see any rises in the coming months?
Yeah, again, great question. I'll say one thing is I'm certainly far more comfortable now that I know there's a lot more people in the country. So the net immigration story has been very quick in coming and helps explain aggregate demand and of course for housing, places to live. We now have a smaller peak to trough decline in our projections for house prices. I think we have them, rather than the 20+%, we've got them pulling up at a 17% decline. There's still a bit to go from, I think we're down at about 14 or something. But the even better news is we are no good at forecasting asset prices. So, all we know is that house prices are now much closer to their sustainable levels, and sustainable levels are not affordable levels. The sustainable levels are the levels at which we can better explain through the demand and supply, the rent versus buy, the invest in a home versus alternatives, the fundamentals. House prices are now much better anchored towards those. So that is a pleasing situation.
And then there was a question about transparency and openness, and Adrian Orr said that the Reserve Bank of New Zealand was one of the most transparent central banks in the world. He's probably right.
From before, Governor, in taking some responsibility for the inflationary environment which we find ourselves in, on reflection, were any of your actions avoidable, and do you regret any of the actions that you have taken?
I regret that the public of New Zealand has had to suffer through this high inflation period. I also acknowledge that that's been the case internationally through the story. But in terms of the decision making that we've had to make through it as a committee, no, we have talked and published our full review. And I'll remind listeners that that is public and it was internationally reviewed and is available. And we talked about, probably in hindsight at best, we could have started raising interest rates 3 to 6 months earlier than what we actually did. But that would have been a small bare difference with regards to the end inflation outcome.
And do you feel like you've been adequately accessible, accountable and faced an acceptable level of in-depth scrutiny over what impact your decisions have had on the cost of living crisis in New Zealand?
Can I remind that it's a committee decision, because I'm feeling very personally attacked here, so I will just remind you of that. It's a Monetary Policy Committee, and yes, I do. We are in front of the public very often, and we're in front of Parliament very often. In fact, at 8 a.m. tomorrow morning, I'm back in front of the Financial Expenditure Committee meeting, and we have done significant international reviews, and we are one of the most, if not the most, transparent central bank on planet Earth.
But if you stand back, you can see that the combination of weaker demand and improved supply has reduced inflation in New Zealand somewhat. Annual consumer price inflation declined from 7.2% in the December 2022 quarter to 6.7% in the March 23 quarter. Prices for some goods and services changed a lot, such as petrol prices and airfares, and they also declined. Inflation declined by more than expected, but it still remains too high. And while many measures of inflation expectations have declined in the last 3 months, they remain elevated. Most measures of persistent or core inflation have stayed near recent peaks, and they think it's going to take some time to come back to midpoint levels. And it's also worth noting that the inflationary pressures continue to be supported in the tight labour market, with employment above its maximum sustainable level. The unemployment rate remains very low at 3.4% in the March 23 quarter, and although most indicators show that the labour market pressures have eased since last year, they remain strong. So overall, high interest rates are still needed to further slow demand, and that's going to help to reduce upward pressure on prices, leading to lower headline inflation. And finally, it's worth noting that they are predicting a recession in New Zealand, a mild one.
Just the Treasury says that they are expecting New Zealand to narrowly avoid a recession. And I was just wondering, what's the Reserve Bank's thoughts on this? Are you anticipating the same?
Paul, do you want to chat about the forward path for GDP?
Sure. The forward path for GDP, table 7.1 in the document. So we're predicting a 0.3 in the March quarter, and then it goes negative 0.2, negative 0.10. So definitely a soft patch in terms of GDP. I think that's a little bit south of the Treasury's projections, but by the same token, I think our projections, we have inflation coming back into the band more quickly than the Treasury does.
So a short, shallow period of flat, if not marginally negative economic growth.
But if I'm not, so that was 2 negative quarters in a row.
You are on the button.
So technically, you're predicting a recession still.
Yes.
Yes.
I mean, technically, you know.
Yes, under the definition of 2 consecutive quarters of negative GDP growth, yes.
Yeah, but you don't. It's not. You don't appear that concerned about that.
Because the minus 0.1 plus 0.1 well within any standard error of confidence of being able to forecast quarterly GDP. So we are concerned that we are going to go through a soft path. What you wish to call it really comes down to how you want to write your story.
It's in the roundings just below zero probably for a couple of quarters, and he did admit that it was pretty much line ball one way or the other. Now, I have to say that I think the Reserve Bank of New Zealand is definitely leading the pack when it comes to transparency and openness, and certainly lifting rates. Either central bank should take a leaf out of their book, I think. And certainly if I compare the communications in New Zealand with Australia, then Adrian Orr and his team wins hands down. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.